Hello, guys. So today we're going to talk about bond evaluation. So there are two worksheet here. First, this is a general example, and we're going to go through these specific individual examples, and I will summarize why the way you approach any bond problems is from the perspective of time value money, right? So time value money is when we calculate for example, one of the five elements, the present value, future value, payment, number of periods, and rate, right? So the mission is to find the fifth element. So you will get the four elements from the question, right? So a typical time value question is, for example, it's like, you apply for a mortgage and then you get this APR, the interest you're paying every year, and this is how much money you borrow from the bank, and it's 30 years mortgage. So asking you like, what is your monthly payment, right? So that's the typical time value money question. And also there's some retirement planning stuff. So bond is also essentially time value money question. So I want you to remember that. This is the key for you to approach any type of bond problems. Okay, so let's start with this general problem. So we have 9 bonds here, and as you can see here, first let me go over these variables. Okay, so maturity means that bond, first of all, it's a debt instrument. It means the corporations, or let's assume all these are corporate bonds. It can also be issued by government agencies, right? If by treasury, it will be treasury bills, notes, and bond, right? The treasury bills is the difference among these terms is bill that's less than a year, and notes is between 1 and 10 years. I would say 2 to 10 years, and the notes, the bond is more than 10 years, okay? All the way up to 30 years. And so it's the corporations and agencies make this available. So basically borrow money from the public. So let's say that the corporation IBM does issue bond, okay? So IBM issues bond, and usually the unit is 1,000. So you got to buy units of $1,000 of a debt issued by, let's say, IBM or Apple or any other corporations, or the government agencies, etc. So in this case, that for example, the par means what is the face value of the bond, right? So let's say you bought a 1 unit of a corporate bond. Here is $1,000. So this is the money, the face value, what the corporation owes you. It matures in 5 years. Let's say that when you purchase today, and it has 5 years left until it matures, right? So when it matures, the corporation will give you back this $1,000, right? Because that's just the principle. And the coupons here, we consider this annual coupon rate, right? The coupon rate is 9%. So to compensate you bearing the default risk, right? So another term you need to write down, okay? Default risk is whenever you lend money to others, corporations, people, okay? You are bearing the default risk, the risk of the other party not be able to paying you back the coupons or the principal. Although such things does not really exist for the treasury securities, because the government can always print more money, okay, to give you back your principal and coupons, right? But other than the treasury securities, right, the government agency securities and the corporate bonds, you are bearing a much higher default risk. Okay, so to compensate that, just like if you borrow money from the bank will charge you interest rate, annual APR. Let's say you spend money using a credit card. If you carry any balance, the credit card interest is ranges anywhere between like 11% APR to like 29% APR. Okay, depends on your credit worthiness and your credit history, etc. So just understand the purpose of the coupon rate here. This is the form of compensation for the investors, right? For the creditors or the debt holders, for them to bear the risk, right? Otherwise, like, why would you want to lend someone the money without the promise that they will give you back, and if you don't have any additional compensation, right? Okay, so the coupon rate, for example, if you bought a 1 unit of this of this bond number 1, and every year you're gonna get paid 9% of the par, right? So if you buy 1 unit, that's gonna be $90, right? $1,000 multiplied by 9%. If you bought, let's say 10 units, $10,000, it's going to be $900 per year. Okay, it's as simple as that. So you see the par value here is in the, and this one is 100 is actually not possible, right? But we just put it 100 here, just just for fun, right? Just understand that typically the bond is issued in the unit of 1,000. Okay, so here, so all unit 1,000. You see the market price here. The market price means that if you want to purchase this 1 unit of bond today, okay, this market price is always updated today. So current price is 1,046. So it's actually higher than the par. So here's the way you say, wait a minute, why is the market price higher than the par? Well, it's because there's let's think about this, right? There's probably a higher demand for this bond because it has such a higher coupon rate, right? And also the market price varies compared to the interest rates established by the Federal Reserve, right? So this is what we call the interest rate sensitivity, right? And you see these bonds that have different maturity years, 5, 25, 18, 10, right? 5 years. So the bond that has longer here, this is an important point. The bond has a longer maturity, means that it takes so many years for the bond to mature for you to get your principal back. They're actually more sensitive, or you can say have a higher sensitivity to the interest rate change. Okay, I repeat that. So the bond with the longer maturity years, because it would be a while, 5 years compared to 25 years, for you to get your principal back, right? Then the risk exposure to interest exchange is much, much higher because you have a much longer investment horizon, right? So just think it that way. So if the maturity is longer, the sensitivity, the market price sensitivity to the interest rate change is going to be higher. Okay. All right. So now let's calculate the current yield. So remember, yield is equivalent of rate of return. Okay. Current yields means that every year you're getting the coupons. What is your return? It's equivalent of you getting dividend from stocks, and your annual dividend divided by the market price. That's going to be your current yield of a stock as well. Yield to maturity, YTM, measures the theoretical, let me repeat that word, theoretical rate of return for the entire duration you are holding this bond, assuming you are getting it in today until it matures. That's why it's called yield to maturity, right? So for example, if you invested $1,046 today for this bond, and your theoretical rate of return, if you hold this for the next 5 years and you get your principal back, is 7.87% return, rate of return a year. Okay, so that's what, because it hasn't been realized. That's why I emphasize on this theoretical. Okay. All right, so let's calculate that. First of all, let me erase these two numbers. Okay, so the current yield is going to be the annual coupon, which is the coupon rate multiplied by the par value. All right, these rates are the annual coupon rate divided by the market price. Okay, so that gives you 8.6%. And the yield to maturity, again, remember I mentioned everything here of bond. So right here, as I created this table, it's time value money, because we are discounting future cash flows. You are getting coupons in the future, a periodical payment, right? Just like the payment element and time value money. And this par value, you're going to get it in the future. So it's a future value at the end of the horizon. And the market price is what you are paying right now, right? Right now. And this is the equivalent of a number of periods, right? So we know that the 5 time value money elements are present value, future value, payment, number of periods, and rate. So these are the basic stuff that you learn from business finance class. Okay, so this is the advanced investment class. So these are the fundamentals that you learn from the business finance class. If you need to review it, make sure that you do more time value money problems practice and go back to your corporate finance or business finance textbook and review the time value money part. Okay, so anyway, so the 5 elements here, the yield to maturity is going to be the rate. And I will summarize after we finish all the examples right here as well. So yield to maturity here, if we want to find rate, I got to know what the present value, future value, payment, and number of periods is, right? I can actually add another column just for the convenience right here, and I can call it annual coupon, okay? So annual coupon would be the annual coupon rate multiplied by the par value, okay? and then make sure this is $1. Okay, so $90. So then let me calculate yield to maturity. So yield to maturity equals, right? I know it's what I'm calculating the rate. And the number of periods is going to be what? How many periods, right? 5 years left. And in this case, it's annual coupon bond. So there's 5 years left. And the payment is going to be what? Is going to be the annual coupons. And this is going to be positive because you're receiving that. Does that make sense? And the present value is going to be negative, right? Negative market price because you are paying that. It's out of your pocket. That's why it's negative cash flow for you. And the future value is going to be the par value because you're going to, again, receive this $1,000 when everything matures. So this gives you a yield to maturity rate of 7.85. Okay. So now I have all these formula. I can simply drag it down to the last row of this table. Right. So you see that the annual coupon, the actual amount is different based on what is your par value. Let's say you bought 10 units of this corporate bond, right, and have 25 years, and your annual coupon is 435, and this one is $20,000 worth of par, and you are going to receive $1,250 per year, right? So the current yield is the relationship between what? Between the annual coupon and the market price. Just understand that, right? Okay. And the yield to maturity is again a theoretical rate of return every year you're going to receive for the entire duration of you holding this bond, right? So for the second one is 25 years. So we can see that like the number 6 right here, number 6 has the highest yield to maturity, right? So the higher the return, of course, is the better for the investors, right? But you would wonder why the yield to maturity is different, right? Why is it different? Think about it. Who would offer? Because if you are getting 13.33 here as return, your return every year comes from the coupon, correct? Because the coupon rate is 12% and is actually selling at the discount based compared to the par value. The market price is actually lower than the par value. So why would a corporation be willing to pay you such a high interest rate? This is almost like a credit card interest rate, okay, to you, because your return is the company's cost. Just like if you're paying the credit card interest rate, your cost is the credit card company's return. Okay, how many of you got that? All right, so this company must be what? Must be a little bit desperate, as I would say, or we usually call this kind of bond is as junk bond, right? So we don't have the bond rating here, but just understand that, right? So when companies issue bond, it's because they want to acquire more capitals for their business, right? But you understand every company on the financial statements, right, balance sheet, you have 3 categories: total assets, and that's on the left hand side. On the right hand side, you have total liabilities and equity. So the bond that the company issued would be recorded under the liability, okay, under liability. So think about this: if the companies already have a lot of debt, right? I'm talking about debt to asset ratio, right? If the companies already have a lot of debt, and the company still wants to borrow, then the investors say, hey, wait a minute, you already have so much debt, then your capability of paying it back, if you issue additional debt, is going to be what? It's going to be smaller, or you can say the default risk is going to be higher when you have a lot of debt. So means that as an investor, if you want me to buy your bond, I have more risk. So give me a higher current yield, give me a higher coupon rate to compensate my higher default risk. Okay, so this is the same thing. Like if you have a bad credit score, if you have a bad credit history, and you go out and you want to apply for mortgage or car loans or credit card, they're gonna give you a higher APR, right? It's because you have a higher default risk, right? So a company's debt to asset ratio, right? If it's higher, then the bond rating would be lower. If the company has less debt, the debt to asset ratio is lower, then the company's debt rating would be higher, right? So the rating agencies, there are 3 major rating agencies. You can write this down: S&P, and the Moody's and Fitch. Okay, so we are. I think most of us are familiar with S&P, right? Because of S&P 500. Okay, so now let's talk about the last column on this worksheet, the discount, par, or premium. So if the market price is higher than par, as I mentioned before, well, it's selling at a premium, right? Because it's higher than the face value. Because the rating is high, the demand is high, the coupon is good. It all depends on the market demand and supply, right? Okay, so if the market price is higher than the par, we call it premium. Okay, and if the market price equals the par, we call it par. Otherwise, we call it discount. There are only 3 scenarios: greater, equal, or less than. Okay, so double click. So you have the first 4 bonds are premium bonds because the market price is higher than par, and the number 5 is a par because the market price is exactly the same as par, and you have the you have the last 4 as discount because they're selling a lower price, right? Okay, so now let's move on to the second worksheet. So here are individual examples. Okay, so first one, just understand what is bond problems again. Is time, value, money. So when you approach bond with this perspective, you will find it very easy for you to solve these questions. Okay, so this video serves as I would say as a summary, and then and also shortcut here, right? Kind of like a shortcut for you to solve the bond problems. So you must also read the slides, right? The chapter 10 slides, and also the textbook if you want a deeper understanding. Okay, just understand that. Practice is the king. You got to practice solving these problems over and over again so you understand that. You understand, right? And why bond problems is time value money, and how to calculate yield to maturity, intrinsic value, and the yield to call, and then so many other different terms. So here, you have a bond, a coupon rate is 7.65% and matures in 15 years. And the market price is 1.065%. So you want to calculate the yield to maturity. Again, yield to maturity is rate, so you got to find these other 4. But you will say, wait a minute, how come I have no par value here? So par value does not be given, right? Because when you log on directory to sell bond, the par is what? If par is not given to you, the par is always considered 100%. That's why the market closing price here telling you is 106.5% of the par. Okay, so if a par value is not given to you, you just use 100 as default. Okay, as default to calculate it. You can actually use $1, $1,000, so it wouldn't matter. Doesn't matter. Okay, so that's why par value sometimes is not given to you. Okay, so you can add one row if you want, or it doesn't really matter. So you can add par here, right? Par can be anything. By default, you can put 100. Okay, just 100. So let me change that to dollar, and this is 100. Again, if you put 1,000 here, 50, 500, it does not change the results of yield to maturity, because yield to maturity is a rate of return. Okay, you see that right here? Yield to maturity, yield to call, realized yield, they are all rate of return. Rate of return for investors, rate of cost for the issuers. So we're going to use rate to calculate that. First of the number of periods is 15 years to maturity, and the payment is going to be par multiplied by the annual coupon rate, right? So you're getting $7.65 per year, and the present value is going to be negative the market closing price, which is 106.5% multiplied by the par. Okay, because this is compared to the par value, and the future value is going to be the par. Okay, and then make sure you have 2 decimals. So this is going to be 6.94. Okay, so your annual rate of return theoretically, if you hold this bond for 15 years, is about 7%. Not bad. If this bond is a AAA or AA bond, I would totally get it. But most likely, based on the current bond yield on the market, this is most likely is a junk bond. Okay, or like a municipal bond that has a high risk of default. So I would not recommend. Just really, you need to pay attention to the rating. So next one, the coupon rate is 3.85 and it matures in 21 years, and the investors required yield is 4.25%, and the par value is $1,000. And then asking for, hey, intrinsic value. What the heck is intrinsic value? So let's add that here. Intrinsic value is the present value. What does this mean? Market price is what the market thinks it is worth. Does that make sense? Just like stock market. Why is Apple's stocks is selling at, like, say, $120 per share? Okay, because based on the buyers and sellers consensus, and then they think $120 fair. If it's not fair, then there'll probably be more buyers. If it's cheap, and more sellers. If it's expensive, and eventually they're going to reach equilibrium, and you will see the price reach that point. So in this case, the intrinsic value is essentially which element? The present value. Because you have an investor, you have your required yield or return of 4.25%. You said, hey, you know what? I want my money to make 4.25% a year. That's my target. All right. So now if you have a target that gives you the rate you want, and then this gives you a coupon that's a 3.85, and matures in 21 years. So the question is, how much are you willing to pay? Because you want to get 4.25% return. So the question comes down to calculating what? The present value. See that? It's, again, the time value money. So let's use PV, and the rate is your investor's required return, and the number of periods is going to be 21. You can also type instead of using your mouse. The future value is going to be C17, right? And actually, we need to put payment here. So payment equals the coupon rate multiplied by the par value, and the future value is going to be C17, the par value. So the present value is going to give you a negative number, right? So because the coupon rate is only 3.85, and you want your money to make, you want your bond investment to make 4.25% return a year, so you have to pay less. If you pay the same as par value, you are going to get 3.85%. This means that if the market price, again, if the market price is the same with with the coupon rate, that your yield to maturity is going to be the same with the coupon rate. Okay, so another relationship we have here, if you increase your required rate of return, the intrinsic value would go down. Just like you're getting coupons that is 3.85% a year. So the more you want to get, the less you want to pay, because the less initial investment you have, the higher your return is. Okay, so let me change this number so you guys will get it. So now it's 4.25. Let's change it to 6%. If you want your money to make 6%, then you're only willing to pay $747 for this bond, because with 3.85% annual coupon, you will only get 6% annual rate of return if you pay $747 as your initial investment to get that $1,000 face value. All right. So to summarize, what we just the examples we just did, the investor's required rate of return, or the yield, is negatively correlated with the intrinsic value, or let's say the price you're willing to pay on the market. All right, so let's go to the next one. This one has a coupon of 5.25, a little bit higher, matures in 2019. Okay, so let me update that, because this worksheet is from a few years ago. So let's say it matures in 2030. Okay, and it purchased in 2004. That's fine. And the purchase price is 19.5% of the par. And the current market price is what? Is 102. Okay. So now we're talking about realized return here. And again, if you want to add a row here, just put on par at $100 because it's not given to you. That's totally up to you. Or you can simply just incorporate this into your calculation, but make sure you change that into a number or a dollar unit first. So let's say you bought in 2004, right? You bought in 2004, and then to this year is 2020. So if you bought in 2004, you plan to sell it today, and today is not the end of 2020 yet, right? So usually the coupon is paid out at the end of the year. So you got the coupon in 2014, and you will not get the coupon of 2020. So the effective period, holding period that you have if you sell it today is 2020 minus 2004. is going to be 16 years, right? But if you sell it at the end of 2020, you will also get the coupon for 2020 as well. In that case, it will be 16 plus 1. It will be 17 years, okay? So the realized yield, if it's so today, we know the number of periods is going to be what? Is going to be 2020. So if I type a Excel function here as today, and I want to point out the year of today, okay? Then Excel will tell me this year is 2020. So you are using Excel to tell you the current year. So if you opened up this spreadsheet, let's say next year, this cell will give you 2021, okay? So because we want to have a 2020 right here, so we can calculate the difference. So realized yield, again, this is what? Rate right here, right? Calculate rate of return. So we use rate, and the number of periods is going to be 2020 minus 2004 when you got it. The payment is going to be 5.25 multiplied by $100. That's a par. And the present value is going to be negative because you paid it, negative 95.5% multiplied by the par right here. The future value is going to be today's price here, realized yield if you sold it today. So 102% multiplied by $100, okay? So let's close that out. So if you sell it today, it's 5.768%, okay, let me 5.77%, okay? So this is the calculation. So realized yield is talking about from the day you purchased it until the day you sold it, okay? So realized yield if you hold to maturity, then in this case is 2030. Again, maturity means that December 31st, 2030. It usually expires at the end of the year, right? So it means that you are actually going to get what? Going to get the difference between 2030 and 2004 plus 1, right? Plus 1, right? Because you're getting the coupon in 2030 as well, okay? So let's do that. So of course, realized yield is still calculating the rate, it's time value of money. So let's plug in the other 4 numbers. Number period is going to be maturity year minus when you purchased it plus 1, okay? Because you're gonna hold until the end of the year. The last payment will be the last coupon plus the principal, okay? So the present value, of course, when you bought it, so it's 95.5% multiplied by the par value, and oh, we need to calculate payment in this case. So payment is, again, the annual coupon, 5.25% multiplied by the par. And the future value is going to be when you actually, when it matures. So it's going to be what? It's going to be, okay, let me pause here. So we just did payment. So now let's calculate the present value. So the present value is when you purchased it, right? Okay, let me go back. I suddenly lost track of which element we just did. So we did the number of periods, which is the difference between 2030 and 2004 plus 1. That's good. The payment is the annual coupon, 5.25% multiplied by 100. Perfect. The present value is when you bought it, it's negative 95.5% multiplied by the par because you paid it. It's negative for you. Make sure you click on only the par value. And the future values is when you hold to maturity. In this case, you're gonna get $100 back from the company. Perfect. All right. So if you hold to maturity, the you hold to maturity is below, right? The realized yield is below. Why? Because currently the market price is higher than the par. Okay. So whether you decide to sell it today or in the future, it's up to you, right? So if today the price is high, if I have other opportunities to invest this money, I would sell it today and to get this 5.77 because I don't want to be stuck here for the next 26 years only making 5.5% return. But if the bond portfolio is a part of your portfolio, like the bond part, then you might want to keep it. Okay, it's up to you. So let's do the last example before we conclude the bond evaluation pricing. So we have ABC bond, the coupon is 8%, matures in 20 years, and it's callable. So let me explain what it means. So callable means that the company has a right to call the bond back before it matures. Okay, so why do one company do that? Because like I said, the longer the term is, the more sensitive the price is to the interest rate. What if in the next 20 years, in the next 10 years, the interest rate established by the Federal Reserve, dropped dramatically. Now it's much cheaper for the company to borrow money, right? So the company, it doesn't make any sense for the company to pay 8% still. So the company gives itself an option to call it back in 10 years if the interest gets lower, so that they can issue new bond to get a lower cost. Remember, the coupon you're getting every year is your return, but it is the company's cost, right? It is the company's cost, okay? So that's why we have callable bond. So callable bond, usually the company will give you a premium, right? In this case, it's 3%. So 3% of the par, right? So you're getting 3 extra percent, encourage you to sell it back to the company, right? Because callable bond has a higher risk for the investors than the bond with no call options here. So we talk about these 3 bonds that has no call options, right? So you gotta hold until it matures where you sell it on the market with the current market price, okay? Why it is more risk for the investors? Think about this, right? Now you're guaranteed for, let's say, a return, right? 8% a year for the coupon. But in 10 years, you have a chance of getting this bond called back by the company. So then you're getting to cash position again. You got to think about when and where and what you want to invest those free cash flow again. So you have what we call the opportunity risk. Okay, so that's why it gives you a core premium to compensate that risk. So anyways, here it doesn't have a par value. Again, you can add 1 row. You don't really need to do it. Okay. Okay, one moment. I can simply add the par value right here. Okay, so insert. I'm gonna shift the cells down. Oh, I have these merged. So okay, let me just simply do this. 1 moment, guys. Let me put it up there. Okay, put a par value right here. So make it 100. Great. So yield to maturity here. Let's calculate yield to maturity first. First of all, what is the market price? It is the number of periods, of course, is 20, maturing 20 years. And the payment is going to be 8% multiplied by the par value. And the present value is going to be negative 106.5% because that's the market price multiplied by the par. And the future value is going to be 100, right? So this is very simple. So your yield to maturity is 7.37% if the bond doesn't get called back. So what is the yield to call, right? So that's the point of this example. So yield to call right here, let me highlight this, okay, is saying you buy today, you can get called back in 10 years. So again, that's same, it's rate. And number period is gonna be 10. Payment is still the same, 8% multiplied by the par. And the present value is gonna be the same, okay? 106.05 0.5% multiplied by the par value. And the future value, here's the key. The future value is the par multiplied by 1 plus the premium, because instead of 100, you're getting 100 plus 3% of the par. So you're getting $3 extra in this case, okay? So that's why you want to include that. So your rate, your yield to call right here, you see that is actually lower. You guys see that? All right, because so it means that holding until maturity is a better deal. But in this case, if it's called, then you have a potential risk of getting called. But you got to think about where you want to invest that money again. But anyways, remember that. So when you calculate yield to call, the future value is the par value plus the core premium. I repeat it. When you calculate yield to call, the future value is the par value plus the core premium, because you're getting some premium plus the par when your bond get called back. Okay, but when you calculate yield to maturity, your future value is the par, because you're only getting the face value back. There's no premium. All right. So let's summarize what do we have learned so far. First of all, bond are debt instrument. Remember, okay, bond are debt instrument. So there's an issuer, there's a buyer, and for investor bear their default risk, right? That's why there's a coupon rate to compensate that risk. And the higher the coupon rate is, that means the higher default risk you're likely to bear. The yield to maturity is the theoretical rate of return if you hold this bond all the way down, all the way until it matures. So the higher the yield to maturity is, the higher return for you. But the yields usually the yield to maturity the higher it is, the higher default risk is, right? So we don't have the ratings here, but most likely this number 6 is the junk bond. And the time value money is essentially what it is, what the bond problem is, right? You're finding a 5th element, but you need to find the other 4 from the question. And the discount or par or premium is determined by the relationship between the market price and par. If the market price is higher than the par, it's premium. If it's equal, and it's par, and if market price is lower than the par, it's discount. Just look at this table summary, okay? So you have these terms from bond. So market price, purchase price, and intrinsic value can be used as present value. And the par value plus call premium, in this case, you're calculating yield to call as we did above, is going to be the future value. And if you bought a few years ago, you sold it today, today's market price is going to be the future value, okay? And payment is going to be very simple, coupon, annual and semi-annual coupons. In this case, we assume all these bonds are annual coupons, so coupon bond, so we just calculate the annual coupon. The number periods to maturity, or to the call date, or to the sell date, right? Because we're calculating the holding period. So your holding period could be you bought this 5 years ago, you sold it today, or you bought it today and you're going to sell it when it's called back, or you bought it today, you're going to sell it when it matures, right? So it's different, but it's still number of periods. And the rate, of course, is going to be yield to maturity. If you hold it, maturity T, if you hold it until it matures, and then if it's yield, you are going to hold the bond until it's called, it's going to be yield to call. And once you sold it, so yield to call and yield to maturity, these two are both theoretical rate of return. Realized yield, just like realized return, when you sold your positions on stock market, okay, or on the bond market, now it's realized. The money is in your pocket now. The transaction is over. So realized yield in this case, right? You bought it in the past, you sold it today, it's realized. And then, but let's say now it's 2030, then you just the bond just got matured and you got everything back. Then your yield to maturity at that day is the realized yield. Okay, so this is the high-level summary, and I give you a shortcut to approach the bond problems. Please make sure you read the PowerPoint slides, go through, study the PowerPoint slides, and also the chapter if you want to go deeper. Okay, all right.